The top business stories live from the Sky News Centre. Royal Mail will pass into foreign ownership for the first time in its 500-year history as a takeover by a Czech billionaire gets the green light. Confidence among Britain's manufacturers falls at the sharpest rate since the start of the pandemic as firms warn of rising costs. Plus, in a crucial week for the water industry, we'll hear how it's facing its biggest challenge of the privatised era. A very good morning to you. This is Business Live with me, Wilfred Frost. A takeover of the Royal Mail by Czech billionaire Daniel Kretinsky's EP Group has been approved by the government. The deal, worth £3.6 billion, 5.3 including debt, was given the go-ahead after a raft of legally binding commitments were secured. These include a pledge to keep the 500-year-old postal service headquartered in the UK and protecting the one price goes anywhere delivery obligation. The General Secretary of the Communication Workers Union, Dave Ward, gave us his reaction to the takeover earlier this hour.
Well, obviously, we had concerns about the prospect of Mr. Kretinsky taking over Royal Mail, as our members do and as the country does. But once we understood the reality that the government were going to reach an agreement, which does give a lot of protections, certainly against asset stripping, and does provide investment for the future in Royal Mail, our job is to get the best agreement we can. The agreement that we've got has to be set against the reality that the status quo of Royal Mail at the moment with the current board is just not sustainable. The current board have systematically run the company into the ground. They've failed customers, failed workers, and they've got no money. So with the challenges that Royal Mail faces, the agreement that we've reached gives us serious protections on job security, legally enforceable commitments about the future direction of the company, introduces a radical new governance and business model for Royal Mail, where workers and the union will have a greater say over its future direction, and also creates a meaningful stake for our employees, our members, in the future success of the business.
Our business and economics correspondent, Gurpreet Narwan, joins me now to discuss this further. Gurpreet, quite amazingly, it seems like this deal, maybe it's not celebrated by everyone, but it hasn't annoyed anyone.
Yeah, it's on its way now to passing into foreign ownership. The government announced this morning that it had greenlit the £3.6 billion deal between Royal Mail's current owners, International Distribution Services, and the EP Group. The process, it has taken several months. The board at IDS initially agreed to the sale back in May, but the UK government was reviewing it on national security grounds on account of the role that Royal Mail plays in the country's communications infrastructure. Because of that, the UK government is going to keep a golden share in Royal Mail. This is something that the government does with companies that are considered to be critical to the UK's national security, such as weapons manufacturers like BAE Systems and Rolls-Royce. And because of this golden share, it means that the UK government will have to approve any changes to Royal Mail's ownership, the location of its headquarters, as well as its tax residency. And the group, EP Group, has agreed to keep Royal Mail's HQ and tax residency in the UK for at least 5 years. It's also agreed to the universal service obligation, which means that Royal Mail will deliver first-class post for a fixed price anywhere in the UK 6 days a week, although it has been suggested that second-class mail services could be pared back. It's also been blocked from making dividends to its owners unless the company meets financial targets. And dividends and asset sales will be blocked if they put the universal service at risk, and that, along with an agreement that workers will receive a 10% share of any dividend payment made to the Czech owner, Daniel Kretinsky, means that the business is also on its way, as you heard from Dave Ward just there, to pacifying the unions.
Gurpreet, great stuff. Thanks so much, Gurpreet Narwan there for us. Now, confidence among Britain's manufacturers has fallen at the fastest rate since the start of the pandemic. A survey by the industry body Make UK of over 300 firms found that rising costs have dampened their outlook on the economy. Joining me now is Fahim Khan, senior economist at Make UK. Break down the headline numbers here that we're talking about.
Well, yeah, good morning. And it's exactly as you say. Confidence actually turned quite sharply over the last couple of months. 3 months ago, when we asked our members, what do you think the change in government will bring to the UK economy? More than 60% of manufacturers at the time said, we think that UK growth will actually improve as a result. Now, what we've seen in the latest figures is that confidence has been slashed at its fastest rate since the second quarter of 2020. And despite that, at the moment, we do see production levels are positive, mainly because that's what you expect before the festive period. But there are some strong growing signals of weaknesses in the market, specifically in the domestic market, where manufacturers are seeing their orders decline. Now, for the time being, exports are good. Manufacturers are making sales to the European Union and North America, and that is probably holding the sector up tight at the moment. But there's genuine concern that rising costs over the next 12 months is going to seriously impede the sector's ability to grow.
What are the explanations given for this sliding optimism?
So the expectations around what costs will be like, what the cost scenario will be like in 2025. So we know following the budget, for example, various business taxes were going up. And that is something that is going to be impacting businesses directly towards their bottom line over the 2025 period. Now, what this means is that manufacturers will have to respond in several ways. And one of those could be around cutting staff, it could be pushing back on investment, it could be limiting wage rises, and most likely the scenario would be businesses will attempt to raise prices on goods to ensure that their margins are protected. Now, that's going to be difficult to do on a slowing market and when the demand is falling. But I don't think manufacturers see a lot of ways out of this situation because the cost rises that are incoming, and it's not just national insurance increases, it's also energy prices, also higher wages from the last couple of years with a very competitive labor market. There's a lot to deal with for businesses at the moment.
Just also break down for us exactly what time period we're talking about from this survey. Is it post-budget, pre-budget? And you mentioned the national insurance contribution there. Is that a factor that manufacturers are concerned about?
Yeah, so it's interesting that it's actually a good question you asked because the survey period overlapped the actual budget. So some of the responses were pre-budget and many of them came after the budget. So I think if we were to get a full post-budget response, then the confidence metrics that we presented in our data would invariably been slightly worse, if anything. And so this is probably representing a more modest view of the actual sentiment of manufacturers today.
Great stuff. Thanks so much for joining us, Fahim Khan. Now, business confidence is not just down in manufacturing. New figures out this morning show private sector employment fell at the fastest rate in nearly 4 years at the start of December as firms take stock of changes set out in the autumn budget. Let's bring in now Chris Williamson. He's Chief Business Economist at S&P Global Market Intelligence, the business consultancy behind the research. Chris, just break down some of these numbers for us. But before we get to the manufacturing subsector, overall at a composite level, wasn't too bad. It was above 50, which means expansion.
That's in terms of overall growth in December, yeah. So just expanding there for a second month, we've had a picture of business activity that's largely stalled. So the economy looks like it was growing really quite nicely in the lead up to the general election. We had a good pickup in growth, but that expansion has just suddenly ground to a halt towards the end of the year. So it's a very dramatic change. We're not in contraction territory yet, but it's a stalled picture, and we've got quite a lot of indicators that suggest that things are only going to get worse, not better, in terms of that output growth, things like order book inflows and confidence.
And that's obviously the composite number, which combines services and manufacturing. Break down the difference in sort of sentiment between those two subsectors.
Yeah, so we've had weakness in manufacturing that just seems to be getting worse and worse, and the downturn there is gathering pace. But it looks like that's spreading to the service sector as well now. The service sector was a good support to the economy earlier in the year, but it looks like we're getting that infection of manufacturing weakness through to the service sector, which is struggling to grow now. So manufacturing is very much the weak spot here, but it's that concern that the lack of confidence is spilling over to the much larger service sector.
I'm interested, you said earlier, you kind of used the election as a cut-off point for the sort of perhaps change in sentiment, perhaps change in direction more broadly of the economy. Is that the bigger factor, or is the budget also something that's caused changes? What's your assessment there?
It's the government all round, and this is based on, so the survey asked companies what's happening to metrics like their output and employment and so forth, but we also asked them, if you've seen a change, what do you think's caused that? And so we can analyse that. And what we saw in the lead up to the general election was companies gaining quite a lot of optimism, saying we're in for hopefully a period of good political stability that's going to help us grow, invest, expand. And then after the election, we saw companies saying, hang on, there's a lot of gloom being talked about here. We're getting more worried now. Remember all the talk of the fiscal black holes and so forth, and the government having to address those spending concerns of the last government. So that was an initial kick to confidence that we saw after the election. And then when the budget came through, we've seen companies say, hang on, we don't like these policies. This is not supportive of growth. We're now starting to take a real hatchet to our employment levels. And this was quite dramatic in December, the scale with which companies are pulling back on their hiring. So they're still producing the same amount of goods and services, more or less, on that composite overall level, but they're trying to do it with fewer staff. And the concern here is when those employment numbers start coming through and we see this hit the headlines in the labour market data, it hits consumer confidence and brings in lower spending from households. So you end up with this vicious cycle.
So break it down for us, Chris. I mean, I know you gather this data every single month. It's one of the sort of early data points based on surveys that we get on the economy, and then the actual hard data, whether that's inflation data, unemployment data, GDP data, follows in the months ahead. What would you say is likely to happen in that hard data to come? Are we about to see the unemployment rate pick up, for example?
Indeed, the signals are there. So these survey data are consistent with the unemployment rate starting to rise, actual employment levels starting to fall as employee jobs in private sector businesses really start to come down. So a negative picture for the labour market coming through. For the economic growth data like GDP, the surveys tend to lead that a little bit. So you're a stalled picture. In fact, we've seen the latest GDP numbers come in negative for a couple of months in September and October. So it looks like we're seeing that picture sustained. And there is a recession risk here. That recession risk has grown. Now, the concern here is that the survey is also picking up an upturn in inflationary pressures. We're getting price rises coming through. We've seen these national insurance levels come up. That's going to be passed on to consumers where companies can do it. That's going to put some more inflationary pressure on there. That then really risks a loss of manoeuvre from the Bank of England. If it's seeing the economy turn down, can it cut interest rates? Well, if inflation's picking up again, it's going to be a really tough decision. So it seems that if you get a downturn, the Bank of England may be a little bit constrained as to what it can do with any stimulus.
Chris Williamson, thanks so much for joining us. Good to see you. Thank you. Time for some other business stories. Now, Bitcoin has surged to a new record high above $106,000. Enthusiasm for the world's best-known cryptocurrency is being stoked by a suggestion from President-elect Donald Trump to create a US Bitcoin strategic reserve, similar to its strategic oil reserve. Bitcoin and other cryptocurrencies have risen sharply as investors bet on the incoming administration creating a friendlier cryptocurrency environment. Chinese retail sales slowed in November, while growth in factory output was flat and house prices fell, despite efforts to stimulate the economy in recent months. The report from the National Bureau of Statistics said the economy and employment were stable, but noted complicated external factors, reflective of unease over President-elect Donald Trump's threat to hike tariffs on imports from China. Shares in the French broadcaster Canal Plus have fallen after they debuted on the London Stock Exchange. Shares opened today, giving the media conglomerate a market value of £2.9 billion, but that's since dropped by around 16%. The decision to list in London was seen as a boost in the stock exchange in London, which has seen a series of high-profile departures in recent years. Now, this week, the water regulator will issue its final verdict on how much water companies will be able to raise their bills for the next 5 years, including the beleaguered provider Thames Water. In the summer, Ofwat said it would allow for a 21% rise, while water companies have since asked for 40%. Business correspondent Paul Kelso explains why customer bills are set for a hike.
This is a crucial week for the water industry. On Thursday, regulator Ofwat will say how much bills can go up by, and that matters not just to customers, but to companies, many of whom are in trouble. To understand why, let's go back to the beginning. It's 1989, and the water companies are privatised with zero debt, but have never intended to stay that way. The plan was for private investment and borrowing to fund improvements, so the state didn't have to, and the water companies have been good on their word. £70 billion of debt piled on. They will say the problem isn't how much, it's whether they can afford it and what they do with it. So what have the water companies done? Well, first of all, they funded investments in infrastructure between £4 and £9 billion, a record last year, a total in today's money, £210 billion. But they were also funding payouts to shareholders, £83 billion worth that many people find offensive. But it's part of the plan, deliberate. Investors won't put money in unless they get something out. But it's become harder to defend when we look at this, the dirty secret of the water industry, sewage spills. Sewage outflows, they're caused by these pipes where sewage and rainwater share the pipe. When they overflow, they go into rivers instead of our homes. For decades, the industry didn't even know how often it happened. We know it was more than 450,000 times last year. That has become politically and practically toxic, but it's very, very expensive to fix. And like everything else, the only way the water company can do anything about it is by borrowing. But the cost of borrowing is rising. This chart shows the purple line's water industry cost of borrowing against an index of UK corporate borrowings. You can see the cost for everybody went up as the inflation spike happened, but water was cheaper. The purple line's below the white line. People like water. It was reliable and dull. But look what happens in the summer last year. The lines cross over, the true state of Thames water finances emerges, and water has got more expensive ever since, which means it is costing more and more for them to borrow. Look at this, Thames Water's, after a bridging loan, £3 billion, they're going to pay almost 10%, hundreds of millions of pounds in interest and fees, which means only one thing. At Thames and everywhere else, customer bills are going to rise. Now, this chart is actually one of the more benign in water. It's customer bills over time in real terms, pretty flat. What we're paying at the moment is actually lower than a decade ago. Now, in the summer, Ofwat said bills could rise by 22%. The industry is asking for 40%. And wherever Ofwat draws its line, we are guaranteed to be paying more, and investors are guaranteed to be allowed a higher take from the industry. As long as we've got a privatised system, that's the reality.
Paul Kelso there for us. We'll still come here on Business Live. We'll take a look at how the markets are doing this morning. We'll be right back.
Who's been generous this year? Thank you. Thank you very much.
It's very light. To Wilf, come on Chelsea. I'm upset about this already.
To Anna for our next Downing Street washout.
To save your voice.
To Gareth, take that, mate.
To Mark, as your gnome for loving Chelsea.
What is it?
Love opening presents.
What is in the Secret Santa?
What could it be? I hope it's not insects. Is it to wear? The big bug catcher. So I knew something was going on, but I had no idea how huge it was. It's
Frosty the Snowman. Well, I'm delighted it's not Chelsea related. But it's a Chelsea Football Club gnome, the very best sort of gnome.
I've got a loud mouth, I don't know why.
You ready for the election?
Oh, look.
Camping face. Love it.
Oh.
In your Gen Z way, say it was blue, mid, dank or shallow.
Half the time, I have no idea what people are talking about.
Okay. There, you trap the bug inside. Like that?
This is what I've always wanted.
This is very, very cool. Perfect for mulled wine, just the right size.
Honestly, who thought of this?
I really like it.
It kind of looks a little bit like me as well.
It's very, very kind of you.
Beth Rigby, Sky News.
Me and Count Bin Face there, panel and Count Bin Face.
There you go. Happy Christmas.
And Merry Christmas.
Merry Christmas.
A very Merry Christmas.
From me, Gareth Barlow, and from him, Gary Barlow, a very Merry Christmas. Dad?
Cheers.
A Chelsea gnome it is. Happy Christmas. I would quite like it.
significant day of this conflict.
They keep telling us that they want aid.
And this is what's left of it.
Why only in America?
People want their country to work.
You want a job in a normal life.
Why are these homes empty?
I want you to be honest with people.
That has happened within minutes.
Sky News, the full story first. Free wherever you get your news.
I just took a shower above the clouds. You know why? Because this is the Emirates A380. Fly Emirates, fly better.
Welcome back. Let's have a look at markets. Asia Pacific indices did trade down today, reversing some earlier gains they had in the session. It wasn't too pronounced, as you can see. Hong Kong was down 0.9%, Australia down 0.2%, but Shanghai and Japan were only fractionally lower. Of course, we had that lackluster data out of China earlier today. Well, French stocks have led the declines in Europe, down the best part of 1%. Both declines in Italy and Germany are around about 1/3%. As you can see, Spain just below the flat line. Here in London, the FTSE opened down about 1/3%. It stayed around there, weighed down by gambling giant Entain, whose shares fell nearly 7% this morning after it was sued by Australian authorities over a failure to comply with anti-money laundering rules. British gas owner Centrica also taken a hit this morning following the execution of a share buyback programme, purchasing nearly 500,000 of its own ordinary shares. If we look at the forex markets, nothing too significant today, up and down by about 0.2%, but the pound is higher, as you can see, against the dollar and the euro this morning. Of course, Bank of England coming on Thursday. Oil has given back some of its recent gains this morning, down about 1% this morning. Brent at just shy of $74 a barrel. Joining us to discuss markets, Russ Mould, investment director at the investment platform AJ Bell. Russ, first question to you I wanted to come to is why is a big French media company listing in London, and how's its first day of trade gone?
Good morning, Wilfred. I mean, the reason for the deal is that Vivendi, the parent company, has split itself into 4 parts to try and galvanise its own share price, which has been languishing on the Paris exchange. 3 of those businesses are staying on European exchanges. Canal Plus is coming here to London because the UK's got a fantastic record in the creative and the media industries, and so it's a recognition of that. And also the very British brand that is Paddington, which is one of their key products. So that's the background to the deal. And also London has been looking to encourage companies to come here, making it easy with some rule changes over the summer. As what the shares are doing today, they're down, so that's not quite the feather in cap that London was hoping. The other 3 shares in Europe, Vivendi, Havas and Louis Hachette, are all up. Why is it down? I don't think it's a thumbs down for the business or for the bear. It's just more down to a technical situation. Some French funds who own the parent Vivendi shares aren't allowed to own non-EU or non-French listed shares, so they're obliged to sell whether they want to or not. Whether this represents a bargain for other people to step in remains to be seen, but I guess that's a possibility.
Big events later in the week will be central bank decisions on both sides of the Atlantic. Russ, what are you expecting, and what does it mean for equities?
Yeah, markets look to be putting more than a 90% chance on the US Federal Reserve cut on Wednesday, and a bit of a coin toss from the Bank of England, 50-50 on Thursday. Generally speaking, equity markets have done well. The UK is up, albeit not as much as the US, and they're up because inflation has been cooling as planned, because economic growth has held steady and central banks have been cutting interest rates. And that's been the dream scenario that the stock markets have wanted, and they've got. The debate has slightly moved on to will interest rates stay higher for longer if inflation stays sticky. So it may not be so much what they do this week, but what they say about 2025, when markets have been slowly but surely reining back their expectations for interest rate cuts from maybe 4 back to maybe 2.
Just very quickly, we've not got long left, but it looks like shareholders will now approve the Royal Mail deal?
Yeah, if the government's happy and the unions are happy, that's a big step forward. They've had and the board is happy. Shareholders have had their chance to voice objections since May when the increased bid came through. So you'd assume that they're happy to take the Czech money and run.
Russ, as always, great to see you. Thanks so much for joining us. Russ Mould joining us there from AJ Bell. Well, as we leave you here on Business Live, the FTSE 100 is down by 1/3%. All of the major averages in Europe down between about 1/3% and 0.5%. That does it for Business Live. Sky News Today up next.